So that's the interest rate restriction, which you'll be glad to hear is probably a good chunk of what I'm going to say, because it is something that's quite current in terms of what we're advising. We'll move on to look at capital gains tax and just quickly summarise this. Capital gains tax kicks in when you dispose of the property. It doesn't have to be a property sale, it can be a gift. Typically, people are wanting to give property to family members, and because they're connected to them for tax purposes, you will crystallise capital gain if you try to do that in most instances. And as we've just been talking about, if you move the property into a company, you also have capital gains tax issues. If you crystallise a gain, it's quite simple these days. We don't have indexation relief, we don't have taper relief, we don't have all these things that were once there. You look at the sales price, you take off the costs of acquisition, anything treated as improvements and stamp duty, etc. You come up with a figure, and the rates of tax on residential property are 18% if you're still a basic rate taxpayer. Once your basic rate band is exhausted, we're into 28. So that's how it works. There are some reliefs kicking around. If you've lived in a property and then you sell it, you've got principal private residence relief, and that is apportioned on a time basis. So you can sometimes mitigate the gain in that way, because you can claim a proportion of relief. At the moment, until April 2020 at least, if you've got a property which you have lived in and you sell, you can get an additional capital gains tax relief called lettings relief. So that again brings the gain down. It may be some planning there. If you are in that situation where you've lived in a property and you've let it since, and you're thinking you might not want it for the long term, you might want to sell it before April 2020 whilst you can get the lettings relief. It's quite generous. It's equivalent to the private residence relief, or up to £40,000. So if you own a property and you've got a gain in it, it can actually wipe out a good chunk of the gain. What else? We've got the annual exemption is currently 11,700, so you don't have to worry about the gain until you're over that limit. The other CGT reliefs kicking around on properties, furnished holiday lets, you can get rollover reliefs, and that means basically when you switch furnished holiday letting properties and there's a gain on one and you reinvest it in another, you can stop the gain from crystallising, so you can change your portfolio around without any tax cost. And the final one there is, I'll touch on at the end, is to do with moving assets through a trust. Furnished holiday lets, these are different, not caught by the interest rate relief changes. At the moment you get full deduction. Quite a lot of this going on in York, and a lot of people are converting lets into furnished holiday lets. I don't know, Ash will be a better place to know whether the market's maybe saturated in that way, I don't know, but people are certainly doing this. Got to meet the rules. You've got to let the property for 140 days a year. It's got to be available for letting for 210. And you can't let it for more than 30 days to one person, otherwise it doesn't count. If you've got more than one of these things, one property meets the criteria, one doesn't, you can actually average over the two properties, and provided you meet the criteria, you're okay. And if you've gone a few years and you've met the criteria and then you have an awful year because the property's flooded, and then you bring it back in, you get a period of grace where it doesn't lose its status just because for 1 year in an exceptional situation you haven't met the criteria. Got to watch the income, it's debatable potentially. So you've got to look at the level of income you're getting from holiday letting activity. If you go over the 85,000, you need to register for VAT. And also if you've got any other business, if you're a VAT registered person and you do a holiday let, you've got to include it on your VAT returns, so just be very mindful of that, and the structure in there will become crucial. There's a lot of speculation about the VAT threshold dropping, so at the moment it's probably less of a concern. The Chancellor has decided to hold it, but clearly if you're in the furnished holiday letting market, you need to be aware of what the VAT threshold is, particularly if it drops as low as what some people are saying, which is about £20,000. Allowable costs are very similar to what we've looked at on the buy-to-lets. Well, key difference is you can get capital allowances on the things that you put into a holiday let, your fixtures, fittings, sofas, beds, all that sort of thing. And if you use it personally, you have to account for that by making a restriction of those costs. And the losses are very similar to buy-to-let. They essentially they roll forward if you can't use them against other holiday letting activity. And there's just some, I think we've touched on most of these things. The income from holiday letting, it's quite an interesting thing. If you own a property jointly, we'll come on to the default taxation position. But because it's akin to a trade, it has a lot of the hallmarks of a trade, you can actually divide the profit from holiday letting activity in a different ratio to the ownership, even if you're husband and wife. And that often leads to some planning if you've got, you know, one spouse higher rate taxpayer, one not so paying as much tax, and they may take a larger share of those profits. So you're not bound by the normal default taxation of property rules. And the income qualifies for pension contribution purposes. So if you are looking at trying to do a pension scheme, holiday let could be a good way of doing that. Inheritance tax relief used to be available on furnished holiday lets. There's been cases to and froing either way through the courts as to whether that's still the case. What used to happen is you've got something called business property relief on that activity. A little bit more difficult to get that now. You've got to really be heavily involved, and the scale of what you're providing as part of that activity has to be fairly substantial to secure that. It's what I just touched on a brief time ago, the taxation position of property income. Husband and wife, the default is that you share the income equally, unless you make a formal election with a revenue that you're going to own the property in a different split, and then you can follow that split. But it really does have to have substance, and you have to make the right elections. But it does work, and some people choose to do that because, again, trying to get income onto a lower earning spouse, that's the planning. If you're unmarried but own jointly, you, regardless of how you own it, the property, you can split the income however you like. So don't feel you have to follow the 50-50 default. Finally, a word on trusts. A lot of changes in 2006 meant that trusts sort of fell out of favour. And it is a bit of a complex area, I don't want to sort of bore you on it, but it's just worth noting that if you've got an inheritance tax problem because of the scale of your property portfolio, and you are wanting to pass assets on to your children, that these need to be adult children, not minor children. But you can use the trust quite effectively to move a property without crystallising the capital gain. It only works up to your nil rate band for inheritance tax purposes, which is a valuation of up to $325,000. What happens is you move the property, say the property's worth $300,000, you move it into a trust. It's an inheritance tax event, but the rate of tax is zero, so it doesn't cost you anything to move it. But the fact that there's a zero rate of tax in the background gives you the ability to stop the capital gain from crystallising at that point. The property then sits in the trust for a while. The trust is set up with the revenue, so it's got substance. It takes the income. You've got to be prepared to lose the income as well as the capital. But the trust takes the income, can then be paid out to beneficiaries, i.e. the child that the property is intended for. And after a couple of years, you then make an exit from the trust. You take the property out to the child, the adult child, and again, because it's coming out of the trust before it gets to the 10-year point, I won't go into the relevance of that, but usually you'd want to run these things for 2 or 3 years. It goes out a 0% inheritance tax rate again, and the fact that it's got a 0% rate to it means that you can again defer the capital gain. Fairly complex whole planning, but what you end up with is your adult child owning the property with your historic capital gains tax base cost also sets the clock going for inheritance tax. So you've got 7 years to survive the gift. You've got to completely exclude yourself from benefit, but 7 years to survive the gift. You've managed to remove 300, in my example, 300,000 out of your estate. You've got your children owning the property and taking the income, and so good result all round if you don't want to actually sell the property in order to mitigate your inheritance tax. So that's me just about done.